Welcome to another fun-filled, action-packed episode of Bill K the CPA. I'm Bill K, the CPA. As we begin our journey into cost accounting, it's important to first get back to the basics to set the stage for future topic coverage. Now today we'll be discussing two significant disciplines within the accounting profession: financial accounting and managerial accounting, which subsequently will include cost accounting. While both disciplines involve the consideration and analysis of financial data, they serve distinct purposes and cater to different audiences. We're going to take some time today to explore the unique characteristics and applications of each discipline so you have a better idea on the big picture of how both areas fit into businesses everywhere. Before we move into managerial and subsequently cost accounting, let's take some time to dial things back and revisit financial accounting as a discipline. Financial accounting establishes the foundation of a company's external financial communication to countless stakeholders, both inside and outside the organization. The core function of financial accounting includes the periodic recording, summarizing, adjusting, and reporting of a business's financial transactions over a specific period of time. Now, when we talk about specific periods, we usually look in terms of a fiscal year or a calendar year, but other times this may mean quarterly reporting periods or semi-annual reporting periods. The most significant output from financial accounting processes includes the standardization of the financial statements. You may recall the income statement, the balance sheet, the statement of cash flows, and the statement of retained earnings. Each of the financial statements provide a historical overview of the company's financial performance, financial position, and their cash flows. You may recall these financial statements if you head on over to the investor relations page of any major corporation. If you're curious enough to browse around those websites, you go to the investor relations page and you could pull all of these financial statements from a publicly traded company. Now, the fundamental principles guiding financial accounting in the United States are referred to as the Generally Accepted Accounting Principles, or GAAP with two A's. These principles, such as the accrual method of accounting, ensure that transactions are recorded appropriately and accurately, providing a consistent and verifiable view of the entity's financial health in a standard manner, making the organization comparable to all other organizations who also comply with generally accepted accounting principles. What distinguishes financial accounting from other accounting disciplines like managerial and cost accounting is financial accounting's primary audience and the focus on compliance with key regulatory frameworks. The main purpose of financial accounting is to inform external stakeholders such as investors, creditors like banks, government regulators, and most importantly, the general public. The trust of the general public to what is being presented on the financial statements is absolutely crucial. This is why so many detailed standards are established on how financial information needs to be recorded and reported on those financial statements. The public wants to be confident that the information provided on an income statement or on a balance sheet is being fairly presented and is accurate. Now, by complying with GAAP or another applicable financial reporting framework, organizations and businesses are able to achieve that required level of confidence. Next, we're going to take a look at the basics of managerial accounting, which you may have covered in prior courses. This will set the stage for what we'll be covering throughout our cost accounting content. Managerial accounting has the lens and the focus on providing useful financial information to key individuals within an organization. Managers, directors, and executives in a business all find themselves making operational decisions and long-term decisions that will both impact the outlook of the company and possibly help to provide a competitive advantage against other businesses that may be providing similar products or services to a market or a customer base. Think of managerial accounting as the company's internal compass or its magic 8-ball, pointing the business in the right direction by helping managers make smarter and more informed decisions every day. Unlike financial accounting, which is the accounting methods that outsiders like investors or the government sees, managerial accounting isn't bound by any particular strict rules. Instead, managerial accounting focuses on what's most helpful for guiding the business forward and going with strong strategic directions. This can include things like figuring out what resources are expected to go into the making of a product, analyzing the profitability of different services, or just budgeting for future projects, making sure that there's enough funds available. The information that managerial accountants are spending their time working with really come down to two value-added attributes: timeliness and relevance. Timely information is available quicker, while relevant information is high-quality, impactful numbers that can result in more effective decisions being made by the company. Financial accounting is more of a collection and accumulation of historical transactions, but managerial accounting focuses on what's timely and what's relevant today. We want to make quicker decisions. Managerial accountants work closely with executives to help them understand how different parts of the company are performing, to identify areas for improvement, and to allocate resources effectively. So, whether an executive is deciding on whether to launch a new product line, evaluating employee performance, or simply trying to find ways to reduce waste around the organization, the insights provided by managerial accountants are essential for steering the company in the best possible direction, given the facts and circumstances surrounding the business. If you like strategy and planning for the future, managerial accounting may be better suited for your interests over other accounting disciplines like financial accounting. Now that we've gone into some refresher material about the high-level focus of managerial accounting, let's take things a step further and explore the cost accounting discipline. Cost accounting is an important area within the world of accounting, honed in on recording, analyzing, and reporting the costs associated with producing goods or services. The primary goal of cost accounting professionals is to help the leaders of a business understand their expenses. Expenses have so many facets, but especially when we talk about companies that manufacture their products for sale. This analysis of expenses involves breaking down costs into various categories, such as direct materials, direct labor, and manufacturing overhead, which include all other indirect costs like your factory's rent, utilities, and also the depreciation of your machinery being used to produce your products or services. Cost accountants will also optimize operations by identifying efficiencies and ways to minimize costs. Now, for example, maybe a cost accountant is able to pull industry data from different vendors who provide the exact same raw materials to build a product. The cost accountant would recommend maybe the cheapest offer out of the bunch of vendors, assuming the quality is identical between all options. So in doing so, it's going to optimize the cost efficiency of the business. Now, that's a very simple example, but there is one nonetheless. Another value-added activity that cost accountants perform is to help make informed pricing decisions. By tracking direct materials, direct labor, and manufacturing overhead in a thorough and analytical manner, cost accountants have the ability to provide a detailed picture of where money is being spent and how efficiently resources are being utilized within that production process. This efficiency can be the difference between capturing a larger market share or maybe allowing your competitors to steal more customers away from you because they're undercutting you with their pricing. While both types of accounting disciplines appear to be closely related, cost accounting differs from managerial accounting primarily in its scope and in its focus, even though both of them do serve internal decision making with executives and managers. As we've just covered, cost accounting is considered more of a specialized subset of managerial accounting that specifically deals with the measurement and the reporting of costs related to production. Managerial accounting, on the other hand, covers a broad range of financial and non-financial information used by managers for planning, controlling, and just overall decision making across the entire organization. This means managerial accounting utilizes the cost data generated by cost accounting, but also incorporates elements like budgeting, performance analysis, and strategic planning, making it more comprehensive and a more comprehensive tool for those who are running things internally within the organization. We're now going to take some time to explore the relationships between managerial accountants, financial accountants, and the various key stakeholders in a company. They include regulators, investors, company personnel, and more. I'll take you through a few common examples, starting off with government regulators. Government regulators such as the Securities and Exchange Commission or the Federal Reserve will have specific professional relationships with a company's accountants to ensure that the businesses are in compliance with applicable laws and regulations. Different industries, such as the banking industry and the insurance industry, they have specific rules that need to be followed to protect the general public. Accountants prepare and submit financial statements, tax returns, and other reports that regulators use to monitor the adherence to different things like the tax code, the financial reporting standards, and other legal requirements that they must adhere to. Certain regulators may also work with accountants during audits or investigations to verify the accuracy and legality of financial activities. If you've ever heard of the Internal Revenue Service or the IRS, that's a great example of a regulator coming in and needing to review documentation of a business to ensure that that business was accurately reporting its tax basis of accounting on those submitted tax forms. The relationship between businesses and regulators is primarily one of compliance and one of oversight, with accountants serving as the bridge between a company's financial operations and those applicable regulatory bodies. Next, we have investors. Investors rely heavily on accountants to provide accurate and transparent financial information that helps them make informed decisions about their particular investments. Another value-added expectation from investors is that the information provided by accountants are comparable to other companies within the same industry, so investors see how the market is holding up. Depending on the equity structure of a business, investors can be a small group of private equity owners, or they can be shareholders who own individual shares of stock which are publicly traded on the stock market. Different investors have different expectations of the accounting records depending on the context of the business's ownership structure. For example, a small family-owned private business may not need the same level of financial disclosures as a publicly traded corporation registered with the Securities and Exchange Commission because that family-owned business may have more of an insight on the day-to-day operations of the company than, say, someone who is just owning a few shares of stock who want as much detail as possible, going to that investor relations page and getting all of those disclosures in those financial statement footnotes. Now, accountants will prepare financial statements like the income statement, the balance sheet, and the statement of cash flows, which investors will use to analyze and assess a company's financial health, profitability, and their future growth potential. Investors also depend on accountants to ensure that financial reporting adheres to established accounting standards, providing a reliable basis for evaluating investment opportunities and tracking the performance of their holdings. So a lot of good reasons there why investors are such key stakeholders and rely on the work of accountants. Next, we have banks. Now, banks, whether they're the big financial institutions or your local credit union, they work closely with accountants when businesses seek loans or lines of credit. Accountants are requested by banks to provide the necessary financial documentation, including financial statements, projections, and maybe cash flow analyses. With this information, banks will use those documents provided by the accountants to assess a company's creditworthiness and their ability to repay debt. From the bank's perspective, they only have a finite amount of money that they can loan to businesses, contrary to popular belief, since the banks always appear to have an endless supply of money, which is not true. Now, with this finite amount of money, banks only want to loan it out to businesses that have a higher likelihood of paying the bank back with interest in that requested period of time. Now, during the term of the loan, banks may also require ongoing financial reports prepared by accountants to assist the bank with its monitoring of the borrower's financial condition. This may help ensure compliance with loan covenants that were agreed to between the bank and the business. There may also be other financial services and other interactions between the banks and the businesses where accountants may need to get involved, but business loans are certainly one of the more crucial areas. So the next key stakeholder, well, that includes executives. Executives such as the chief executive officer and the chief financial officer, right? They're going to rely on accountants for high-level strategic financial information and insights to guide the overall direction of the company. You could think of executives as the overall leaders, identifying the general direction in which the organization needs to move. Another example would be the captain of a pirate ship. You have the crew who get the ship heading in the right direction, but the captain is the person who makes the decision on where the ship needs to go. Accountants prepare comprehensive financial reports, forecasts, and analyses that inform executive decisions regarding mergers and acquisitions, capital expenditures, long-term financial planning, and risk management. They provide critical data for evaluating the effectiveness of business strategies, setting organizational goals, and communicating financial performance to those stakeholders. Executives need timely and relevant information on whether their operational decisions are achieving the goals and objectives that were initially set by those at the top level. If the results are not where the executives want them to be, it may be time to change course or decide on a different strategy to drive more profitability for the business or whatever other goal is of the highest priority. Now, accountants serve as key advisors to executives, translating complex financial data into actionable intelligence for top-level leadership. Some of the best accountants are the ones who could take tons of detailed and complex information that executives don't have the time to sift through and summarize that data into quick and easy to understand visualizations or tables with numbers. Accountants are sometimes considered to be an executive's best friend, and they add tons of value along the way. So now going down a level from executives, we also have managers. Managers within an organization help run the company's day-to-day operations, whether it's for a specific manufacturing department or tied to other strategic elements of the organization. The roles of managers will vary department by department, especially when dealing with different companies ranging from the service industry to the merchandising industry to the manufacturing industry. The wide-ranging roles of managers will step into will vary across all departments, such as human resources, the warehouse, marketing, production, customer service, finance, sales, and plenty more. Managers in virtually all departments of an organization will extensively rely on accountants for internal decision-making, for planning, and to help with their controls over the accuracy of internal and external reporting of information. Accountants will provide detailed financial reports, budgets, projections, and cost analyses that help managers understand operational performance, identify areas for improvement, and then allocate their limited resources in the most effective manner they can. Companies don't have access to unlimited resources, so they need to selectively identify the best place to allocate the time and the energy of those team members. Let's go through an example where a production team has only 5 employees. Should all 5 employees work on manufacturing pickup trucks only, or should 3 employees manufacture pickup trucks while the other 2 employees manufacture sedans? Well, depending on the detail provided by accountants, managers may decide to allocate their resources to meet the expected demand for certain products. Let's say that nobody wants to buy any sedans this year, and the only cars that are going to get sold are going to be those pickup trucks. Well, in that case, managers should make the call to allocate more resources to building more pickup trucks rather than sedans, so the company doesn't end up with stale inventory of sedans that customers don't want to buy. But accountants will help provide information for managers to drive those decisions to identify which direction they should be allocating their resources. Now, accountants also assist managers in setting financial goals, evaluating the profitability of certain projects, and making strategic choices regarding pricing, production, and marketing. They serve as crucial partners in providing the financial insights needed for those day-to-day operations and for that strategic direction. Now, the next key stakeholder, well, that includes employees. We're making our way down from executives to managers to now employees. Employees interact with accountants primarily through payroll and benefit administration, though the broader financial health of the business reported by accountants also impacts the job security of each employee and the company's potential for growth, meaning more opportunities. With company growth comes more personal growth opportunities for each employee's particular career accomplishments and their career trajectory. If the business is in poor financial health, Employees may want to understand this information to either help turn the ship around or to prepare for their next career destination in a more successful business, if you catch my drift. As for the payments to employees, accountants process payroll, manage tax withholdings, and ensure the accurate calculation and distribution of employee benefits. They may also provide information about the company's financial performance that can influence employee morale, compensation discussions, and overall understanding about the company's stability and potential success. Most companies will have monthly or quarterly share-outs where executives provide all employees in the company with the financial details of how well the organization is performing. This helps level set expectations on whether company layoffs may be on the horizon or if the company is exceeding all expectations due to excellent performance and there may be some raises and bonuses on the horizon. So moving on from the internal team, from the executives, managers, and employees, now we're going to move on to the general public. The general public's interaction with accountants of a company is more of an indirect interaction, but it is essential for a well-functioning economy and a well-functioning society there. So, as you know from your financial accounting courses, accountants are responsible for externally reporting the financial health and standing of a business. Through publicly available financial statements of companies prepared and audited that were done by accountants and third-party auditors, the general public will gain insight into corporate transparency, social responsibility, and potential economic impact. This published, publicly available information sent out by those accountants can influence public perception of companies. They could also inform consumer choices and contribute to a broader understanding of economic trends, whether they're good or bad. Accountants may also play a role in ensuring the integrity of financial markets, which indirectly benefits the public by fostering a level of trust and stability that may not otherwise be there. Now it's time for my favorite part of every presentation, the open discussion. If you're in a classroom setting, now is the time to think about a few questions, so let's get chatting. The first question I want you to think about and what I want you to discuss is, what do you think is the most significant difference between financial accountants and managerial accountants? Now the second question, given your personal interests for your career, would you see yourself as more of a financial accountant or as more of a managerial accountant, and why? Third question, have you at any point in your career relied on information from a financial accountant and or a managerial or cost accountant? And if you have, describe the scenario. So now's the time where you pause the video and talk it out, and then we'll wrap things up. Thank you so much for joining me on this deep dive into financial accounting, managerial accounting, and cost accounting at a very high level to set that foundation for a cost accounting course. If you enjoyed the video, please remember to drop a comment, like the video, and consider subscribing so you have access to more fun times as new videos are periodically released.